Good morning, everyone, and welcome to this week's Coffee and Chat webinar. I'm Richard Kalordi, the Marketing Manager for HLB Mann Judd in Perth, and today's topic is passive asset allocation and the benefits of investing over time, with guest speaker Peter Speechley, who is the partner at HLB Wealth, the wealth management division of HLB Mann Judd. As corporate representatives of Paragem, who are also our licensees, Peter and the HLB Wealth team work closely with clients on their investment strategies and offering a number of tailored services for their financial well-being. However, today's topic is around asset allocation, and Peter will enlighten us further on the topic. For attendees, if you have any questions at all during the webinar, please send them through via the Q&A box at the bottom of your screen, and we'll go through them towards the end of the session. Please keep in mind that any advice Peter gives will be of a general nature. Peter, thanks for your time this morning.
Thanks, Richard.
I'd like to start with asking you for a market recap, especially after a very tumultuous few months with the COVID-19 pandemic and its impact on markets.
Sure. Good morning, everybody, and thanks for tuning in. I hope you've got a hot coffee or tea beside you, and we'll have a bit of a chat about what's happened or what's infiltrated our lives in the last 3 to 4 months. First thing I'd like to talk about is just what actually has happened. And it's easy to forget in the sense that it was only a few months ago that we were all lining up trying to get the last piece of toilet roll. And that probably is something that we haven't really seen since potentially wartime. But in terms of the market, what we saw was probably one of the shortest, swiftest, deepest corrections from a market high that we've ever seen, surpassing both Mad Monday in October '87 and also the GFC in 2008. Unlike those occasions, there were systemic issues that caused those. We go back to 2008 and the GFC, and that was the banking system was broken, badly broken, and we didn't realise basically what the extent of that was, and that took some time to recover from. But what we've seen now with the COVID-19 virus is what we're trying to get our heads around is what the demand shock is going to be to the economy. To probably put some perspective to it, in October '87, over 5.5 years, the markets had increased by 608%. So there was a real ramp up of the markets, and I guess everybody, whilst they were making money, it was fine. But at some stage, the markets had to drop, which they did. The GFC, and whilst it's over a longer period of time, but over 19 years, we saw the market increase by 1,200%. In our current situation, we've seen over the last 11 years a 342% rise. What the markets generally try and do is they try and price in what they see in the future. So we like to think that the markets are ahead of the curve in sense of what we found was that the markets kept going down because they were trying to find where the actual bottom was. And once they got to the bottom, it was then pricing in what the recovery was going to be. So we're in that, where is this recovery going to be type stage. However, from an economic point of view, we're now in the midst of a recession. The paper stole my thunder by printing that yesterday and the day before, but the March quarter was a negative 0.3%, and that probably didn't have the economic effects of the COVID virus in there, but we will see, I believe, a drop in the June quarter, which will mean this will be the first technical recession we've had since about 1991. But however, the governments have moved quite swiftly. What I being a bit of a statistic buff, just some things to bear in mind was that back on the 20th of February, our markets had their high and the All Ords were sitting at about 7,255. Between the 20th of Feb and the 23rd of March, the market dropped by 37%. So in less than, well, effectively just a touch over a month, a drop of 37%. The Dow Jones over in the US dropped 36%, about the same. And since that low, our markets have recovered from that low 33%. We're down from our high of about 16%, and the markets at the moment have sort of been vacillating at the current levels. Typically before, we probably would have thought that they've been overvalued and they've potentially, let's hope, found their watermark. So that's a bit of a recap about what's happened from a market point of view over the last few months. Thanks, Richard.
Okay, thanks, Peter. So let's now have a quick talk about passive versus active asset allocation for investors. Could you give us a bit of background on both and the differences for investors?
Yeah, generally what we're talking about here, Richard, is first of all, the asset allocation of people's investments. And it's really an investment strategy that we use to balance the risk and reward by determining what percentage of your net worth to put in various asset classes. When we talk about asset classes, we're talking about international fixed interest, domestic fixed interest, international equities, Australian equities, property, alternatives, and the like. And we like to think, and certainly studies have agreed with us in that a smart approach to your asset allocation can mean far more than trying to pick the best individual stock. And the studies have shown that 90% of the variation in a return from an investor is determined by their asset allocation. Now, it depends whether you see yourself as an investor or a speculator, but the speculators are trying to pick individual stocks that are going to outperform the rest of the market. That's very difficult, and if we all could do that, nobody'd be listening to what we've got to say here, and everybody wouldn't have an advisor or somebody to talk to. But we're great believers in portfolio diversification, and that's determined generally by a person's appetite for risk. Obviously, those that have a higher appetite for risk are going to have more of an exposure to the growth assets, which typically will give you the greater return, but also will have the more volatility than the more defensive stocks and classes such as fixed interest and that. So we try and get a trade-off there depending on where people sit, and often it has a lot to do with their individual circumstances at the time, but probably their age and where they are at in life. This portfolio diversification can be done in two ways. The first way is what we call and what we advocate, and that's a passive asset allocation. And typically what we're trying to do there is to put people into a portfolio in asset classes that meets their risk profile. And typically where there are movements in the market, we're looking to add money via contributions, rebalance back to what our asset class is. And now that doesn't preclude you from changing your investments, because over a period of time, fund managers or managed funds, often the people that are running them, there is change of personnel or a drop off by the fund manager themselves in terms of where their focus is. So it doesn't preclude us from changing those investments, and generally we will do that on a fairly regular basis. And what we're trying to do there is create that alpha or that extra return for you over and above just following an index fund. This type of approach suits a long-term investor that typically doesn't want to worry. They'd like to think that they're going to be taken care of and they'll achieve their returns. And somebody that doesn't want to spend their time effectively monitoring the market and making changes. Now, the other asset class is that of active asset allocation. And typically this is for the people that really are heavily involved in the market, monitoring it on a regular basis. Now that can be done individually or that can be done with your advisor. But typically what you're doing there is trying to pick the tops of the market or when the market is going to fall or rise, and getting ahead of the curve by changing your allocation to various asset classes. Now, if anybody in their crystal ball could see COVID coming, they would have reduced, if you're an active asset investor, you would have reduced your exposure to the more growth type assets because they were the ones that were going to be adversely affected, and go to more of the defensive asset class. A lot of people, what they found after the market drop was that they then changed their asset classes after that, which meant that they took a hit to the growth assets because they were selling when the market was going down. And when they converted to the defensive asset classes, they found that they were very expensive. So there was a double whammy there. So I'm not saying that active asset allocation is not good, but you do miss out sometimes on when you take advantage of that or make your change. There is potentially the markets could still be running, or there still could be more to go in terms of on the downside. So that, in a very general form, is the two types of active or asset allocations that we look at. But typically, most of our clients are investors for 7 to 10 years, and we take that passive asset allocation approach and try and get the returns that we're looking or aiming at.
Mm-hmm. Okay, thanks for that, Peter. I've got a couple of questions that have come through on the topic, which I'll go to now. Question number one is, are there times where a passive approach may struggle to achieve the targeted returns over time?
Yes. The times where we would struggle to get the return that we would be typical of that risk profile is what we call sequencing risk. And that typically occurs when you invest people at a certain period of time and all of a sudden there is a drop in the market. So, for example, if we had invested everybody's funds in January, just before the crash in February, typically people's investment funds could have fell anywhere up to about 30%. It then makes it very difficult because you're then starting on a lower base with that compounding over a period of time to be able to get to, if you're a balanced investor, perhaps an 8% return over a 10-year period. So how do we try and prevent that? Well, typically we do what we call investing in tranches. Where we have some doubts about where the market is, we'll typically try and invest people over time. Now, that won't get us the best of everything and it won't get us the worst, but it certainly reduces the impact or the risk. Typically we had a view that the markets were high at 7,200, and any new clients to the market we were investing over periods of time. Thank you.
Okay, question number 2. What were you saying to your clients when the market had aggressive downturns and all you could read in the newspapers was how many billions were wiped off the share market?
Yeah, it was. I guess everywhere people looked, it was quite scary. And I hark back to the toilet rolls. I had a look for myself at the local Coles one Sunday and was appalled at the behaviour of a lot of people, where it was. We as Australians always like to think that we're easygoing and we try and help each other, but what I witnessed that day really I wasn't quite happy with, because people were very, very selfish in what they were doing. But I guess what we were looking at, or when people were ringing, is that typically for every sale that was occurring on the share market at that period of time, there was a buyer. And admittedly, the depths of stocks and that diminished. There wasn't as much demand, but there was somebody at the other end that was buying. Now, you ask yourself, what is that buyer? What's his thought process in doing that? And typically, a lot of the buyers were the fund managers that we invest in that had basically enough cash to be able to seeing an opportunity and being able to take advantage of that opportunity by buying. And a lot of people that were selling it was panic. They were reading all the negative news. They were seeing the vision of what was happening in the supermarkets and other things. They would go home. Mum and dad would have a conversation. If they didn't have an advisor, they're both worried. They don't know what the impact is going to be. The papers paint the picture that it could be, well, very dramatic, and without the ability to have counsel with somebody that's looking out for their affairs, both people would probably say, look, I don't want to worry of this anymore, and typically we're selling into that. Whereas what we were talking to people about was the education process that we take them through, in that we're investing over a period of time, and looking at if they were to sell now compared to what we think the markets are going to do. So I think in a lot of cases the advisors of the community were there as counsel and comfort for people, to stop them making a rash decision that potentially, as we've seen in history, they were going to regret.
Okay, thanks, Peter. On to our next question. Were there any warning signs that there were strong views out there that the market was overvalued?
Yeah, I think that's a good question. And probably when I think back, what we were seeing when we were doing our client reviews back in probably July 19 was potentially where I saw it starting. A lot of the fund managers, if we're looking at an international fund manager who has a mandate to invest in international equities, because that's basically why we're investing with them, they typically have a mandate of being invested, say, 95% in international equities, and the rest, 5%, is in cash to cope with if there's any redemptions or anything like that. And what we were finding is a lot of those fund managers probably were sitting at about only 80% invested. So that's a fair come down from 95%. And typically, I suppose you question that and say, well, why were they doing that? And in a lot of cases, what they were doing is they were taking some profits off the table. So they were selling into the market, which is a good sign for a lot of investors that were invested there, because I think the July distributions are going to be quite good, in the sense that there's going to be a lot of capital gains distributed. But the other thing was making sure that they were ready when there was a drop to be able to take advantage of that. And I guess from that point, when we were seeing that happening, that's when we started the conservative approach to investing and trying to invest in tranches over that period of time.
Thanks, Peter. Okay, this question is a three-part question, and then I've got an additional final question after that one. Okay, if I was a balanced investor, what would my exposure to growth assets be? What would my expected returns over time? And what would be the percentage prospects of any 1 year to produce negative returns?
Yeah, generally, if you are a balanced investor, and that's about mid-range in terms of between defensive and aggressive, you would have an exposure to growth assets of around 60 to 70%, and defensive assets such as fixed interest and the like of around 30 to 40%. That type of investor is probably looking over that 7 to 10 year period of achieving returns of about 8% year on, year off. And generally, when you're looking at those profiles, we would expect that probably at least one year in 7 for that type of investor would potentially be a negative. And maybe that 1 year in 7 is what we're experiencing right now, unfortunately. However, a lot of our international equities haven't lost much at all. The Australian equity side of things seem to be slower to recover, and the fund managers, although they were still looking a bit sick about a month ago, we have seen the markets pick up 10 to 12% in the last week and a half, which is slowly getting them back to where they were before.
Mm-hmm. Okay, I've got another audience question for you, Peter. Given we're now in a recession, what investments should we be looking at or divesting?
I think at the time this all happened, I think, and generally what happens with markets, they're not discerning, and typically everything is affected. And what we saw was that nobody was really thinking about the future as to whether certain stocks or industries or that were going to recover quicker than others, and everything got pushed back. But then we saw a flight to, well, sensibility or quality, in the sense that people started looking out, well, or observing what was happening around. And, you know, anybody that was trying to get a webcam 2 months ago, wouldn't matter where you went, about the only place you could get one was from China, and you had a 6 to 8 week wait, which means that the Officeworks of the world, the JB Hi-Fis, the Harvey Normans, they experienced a lot of demand that they couldn't meet. It remains to be seen what happens to them once this sort of settles down a bit, in terms of they'll be restocked and whether people will be able to get what they'll be buying effectively. But I think the two areas which probably were prevalent beforehand and are still very prevalent now would be technology and also the healthcare sector. Healthcare sector even more so now because of what's happened. I think a lot of the CSLs of the world and that looking at vaccines and things to help people with their health problems, with people living longer, are going to do very well. Although some of them at the moment are experiencing shortages because they're obviously needing to dish it out to people in need. And the technology side of things, who would have thought that we ourselves were all working from home? Now, I would say even 3 years ago, that would have been something that just wouldn't have happened. But fortunately with us and a lot of other places, we we had a great IT manager who had forward planned a lot of this, and in a short space of time, we were operational, and hopefully people haven't seen any reduction in service as a result of that. And to the point where it's probably meant that going forward, a lot of businesses will be considering people working from home. So they're the type of industries that I would be sort of focusing towards. The other area, I guess, what we've seen, especially in Western Australia, is the materials sector. At the moment, because of the problems over in Brazil, which are, Brazil are one of the major iron ore exporters in the world. Their containment of the virus hasn't been as good as a lot of other countries, and that's affected what's coming out of there. And that's had a big impact on pushing the iron ore price to north of $100 a tonne at the moment. And a BHP that at its worst, I think, got down to low 25s, is now sitting at about $36. And from all reports, their workforces, and Rio for that matter as well, they've been very good in no instances of COVID occurring, and they've been taking advantage of that and exporting as much as they can, which is a real positive for Western Australia in the sense that a lot of our royalties or income at a state government level come from the mining sector, and that will help at least some of the impact that COVID's had.
Brilliant. Thank you, Peter. That now brings us to the end of this morning's webinar. Peter Speechley, thank you very much for your time this morning. To our audience members, if you have any additional questions or would like to reach Peter directly, please email hlb@hlbwa.com.au. And thanks once again. Thanks, Peter.
Thank you.